everyone, good morning. I hope everyone is, well, caffeinated and hydrated because we're going to have a robust, very robust conversation about financial stability, what it means for banks, what it means for consumers, and of course, what it means for regulators. So with me, I couldn't be more delighted to be joined by Klaas, President of the Central Bank of the Netherlands, Suzan, Kereere, President of Global Markets at PayPal. We have Sergio Ermotti, the Chief Executive of UBS, Chow-Kiat, the Chief Executive Officer of GIC Private Limited, and Raghuram, Rajan, Catherine Dusak, Miller Distinguished Service Professor of Finance at the University of Chicago Booth School of Business. So over the next 45 minutes, we're going to try and figure out what we are worrying about, what we're not worrying about, and we should be worrying about, and what can be done about it. So when you look, Governor Knot, at all of the concerns that could put the seeds of the next financial crisis, where do you worry? What parts of the economy should we be looking at?
Yeah, thank you very much, Francine. And this is actually quite some question to start with. Because if you look at all the shocks that we had to weather in the last 10, 15 years and that the financial system had to deal with, most of them were clearly not anticipated and were coming from corners where we didn't expect them. But I would also say that definitely in the last decade or so, after we rolled out the financial reform agenda in the aftermath of the global banking crisis, in the last decade or so, the financial system has been fairly resilient. Has proven to be fairly resilient. There's a little bit of unfinished business, I think, in the non-bank sphere, but at least the banks as core of the financial system have weathered the recent turmoil quite well. And I mentioned that point because also in terms of thinking about future shocks, I would emphasize more the resilience part than trying to predict where the shock is going to come from. We live in a world of fundamental uncertainty. Knightian uncertainty, Raghu would probably say, coming from Chicago. But that means that we financial regulators and also bank risk managements, they like, of course, much more quantitative risk distribution with a given set of shocks where you assign probabilities. Unfortunately, that is not what has created most havoc in the financial system. These were more forms of unpredictable uncertainties, unknown unknowns, as you wish. And given that that is so difficult, I think our emphasis should be, and continue to be, building resilience within the system, even if you don't know where exactly the shock will be coming from. There are enough things to worry about. Geoeconomic, geopolitical fragmentation in and of itself may have disruptive consequences on financial markets, may have some impact on our capacity to work together internationally if there is a problem popping up somewhere in the financial system. New technologies of which are very promising, I think, in terms of their business opportunities, but which may also contain additional forms of interconnectedness in the financial system over and above the traditional forms of interconnectedness. Well, a little bit of that.
Yeah, there's a lot of uncertainty out there, right? And I take your point, Professor Rajan, to what Governor Knot is saying, that actually we've been very bad at predicting any kind of financial crisis. But if we try and see what the hotspots of tomorrow could be, where's the uncertainty?
So I think I agree entirely with Klaas. We can't predict, but we can try and make sure the system is resilient. And so look at the system and see where the weak spots might be building up. I think whenever you look at a financial system, you talk about two things with great importance. One is solvency, which also means leverage, and the second is liquidity. I think we understand solvency reasonably well. It's the liquidity part, which is something which is behind the scenes, which is part of the plumbing. And what we're seeing increasingly, especially with what is happening with the greater focus on U.S. markets, U.S. markets now 65% of global equity markets, but lots of capital flows, maybe with the deregulation even more going into the U.S. The center of liquidity is the Federal Reserve. And you have to ask, is the Federal Reserve going to step up every time there is a problem? Look at what's already happened. We saw in the global financial crisis, the Federal Reserve balance sheet went from 50 billion to 2.8 trillion, okay? Then it came down, but it couldn't come down all the way. At 1.5 trillion, it backed up again in September 2019. Fed came back in. Again, it started trying to reduce its balance sheet. It backed up this time in March 2023 at 3 trillion. The question is, the Fed is supporting the US system, But now increasingly it's going to support a global system. And the question is, what are the gaps? Can it bridge the gaps? So think, for example, what happened in March 2023. It could not support, the system itself could not support the small and medium banks. The Fed had to come in to support them directly. What about internationally? What about stable coins? Are they going to be in the system or out of the system? Who's going to support them? These are the kinds of things we need to examine going forward, because this is where the problems might arise.
Right. Suzan?
I want to bring two additional perspectives to the discussion. The first is going back to your point on the events of March 2023. One of the unintended consequences of those events was small businesses, because two things were true about small business. One was liquidity was concentrated in the big banks, and the second was that as a result of that concentration, many of those small businesses were single-threaded. They literally couldn't make payroll, they couldn't get supply chain payments, and they couldn't get to consumers. So as we think more about what happens to build resilience, that constituent needs to be thought of in the same way as we think about many of the underserved communities. The second point on resilience is, for me, what I remain optimistic about, and I agree, predicting the next shock is hard. But here's what we've seen if you go back in time. We've seen that anytime there is friction, friction is the path to innovation. And if you look at the innovations that have come from financial constraints, open banking is a great example. The fact that half the world now moves digital money in a wallet of some sort, again brought by financial constraints, because so many digital wallets come from local payment systems. They're not interoperable globally, but that allows people to transact digitally. And if you build onto that, where we are with Gen AI, and the things that have advanced very important things to financial systems, especially in commerce, which is understanding the identity of both the seller and the buyer, there is so much innovation that has come from constraint. Now, is that enough? No, but it certainly forebodes that as the world gets more unstable, we're likely to see more innovation.
Chow-Kiat, do you worry that actually in this America First policy, the rest of the world will have to figure out by themselves financial stability, how to support markets and liquidity?
Right. Well, fracturing risk is certainly a big one. But maybe I could just offer two angles. First, just look at what happened over the last couple of years, which we have experienced very stable financial system, right? I think it's largely due to the starting conditions, that credit cycle was benign. As we entered, let's say 5 years ago, even with the COVID, and you got a lot of fiscal support through that period. And I would also give credit to central banks for arresting the spiking inflation. And then going forward, the way we looked at it, the angle is that there are three things that you want to be careful about. First is to be clear about the fragilities in the system. I mean, these are things like illiquidity, leverage, and concentration. That's the first thing. The second, of course, is negative shock. Hard to predict, right? But you could imagine things like credit cycle turning down. There's a little bit of sign of that now, with the fiscal money running out. You could imagine a recession down the road. That's a negative shock that will hit the system. And finally, perhaps the most important is complacency. And this is where the fracturing issue comes in. Because I think we have operated, I would say, for many years with a global system. If that is called into question, I think Professor Rahul touched on that point. Where are you going to that coordination, the lender of last resort? So we are worried about that.
Sergio?
Well, look, I mean, a lot has been said. From my standpoint of view, we are trying always to figure out by stress testing any kind of historical scenarios into, our balance sheets as banks. So I would also echo that as a first order effect, the banking system, I believe, would continue to be able to be strong and provide services and liquidity and support in a crisis. Having said that, one scenario that I think historically has been quite damaging and may come up again is government debt crisis. I mean, if you look at the stack of outstanding debt, if there is a scenario in which inflation is not really coming under control and rates goes the other direction, the cost of that debt will become quite prohibitive, and that may create a quite traditional crisis, an historical one. Big crises are, in the past were driven by government defaults and, I would say real estate crisis, right? So, maybe we shouldn't be too innovative in thinking about, something completely new, and be a little bit more careful about the level of debt in the systems today by many, many countries, and the tendency of policymakers to think that doing more debt is going to be the solution out of it. I don't know how long it's going to last.
And we've seen quite a lot of wobbles in markets. Professor Rajan, I guess the billion-dollar question is whether, what we saw in the last couple of weeks is something that started with US Treasuries and that infected, for example, the UK full front. Do you worry that something bad will happen in the US because it's a much bigger market, like an auction that doesn't go to fruition?
Well, you could have wobbles of that kind, but I don't think the most immediate is the US financing its deficit. The more important question is how this filters into all the issues that Sergio talked about. So, for example, if rates stay high, there is a part of the US private system which is sort of a little fragile. And to the extent that rates stay high for longer, you could see more defaults emerging, both on the retail side, but also clearly on the commercial real estate side and so on, which then filters into the banks. The problem, to some extent, is with the high levels of government debt, when you have contingent liabilities showing up on the government balance sheet, because the private sector is starting to default and needs support, then the question is how much space can the government balance sheet accommodate? That's when, debt levels at north of 100% of GDP in government start becoming a problem, because it's not the debt now. Right. It's the debt conditional on helping the private sector that you worry about.
But Governor Knoto, what happened when you started raising interest rates? The big worry was shadow banking. Yeah. Right? What would happen to that? And actually, very little has happened in terms of, some of the debt that they accumulated. Nothing's really bad has happened in the last 4 or 5 years.
No, that is true. But I would say that those episodes where we've seen turmoil in the financial system, and for a moment, putting aside the sort of banking mini crisis that we had in March 23 in the second tier US banking industry, and also the one institution here in Switzerland, that I believe, whose troubles were unrelated to the macro-financial backdrop. But other than that, we have seen the dash for cash. We saw the Archegos case. We saw the UK LDI pension fund issue. Recently, the yen trade in August, etc. And what all these episodes have in common is that somewhere in this non-bank space, all of a sudden, pockets of leverage pop up where we didn't expect them beforehand. And so the vulnerabilities, also the one that Sergio mentioned, the vulnerability of public indebtedness, you can worry about it, but when does it have financial ramifications? If all of a sudden it interacts with weaknesses in market-based finance. Now, we've tried to strengthen the resilience of some of the major players there, so open-ended funds, money market funds. But there are still a couple of cross-cutting issues in this shadow banking sphere. So I mentioned leverage. Another one I should mention is preparedness for margin calls, which is also those liquidity buffers are also have proven to be inadequate at different moments in time. And that is what we have to fix. That is what we have to fix. I mean, vulnerabilities will be there, shocks will be there, but we have to make sure that they don't have these strong ripple effects through the financial system. And again, most of the potential for ripple effects, in my view, are still in this non-bank sphere.
But Sergio, we don't really know where deregulation ends up in the US. Is that a big concern, that the US banks will be tested to a different kind of metric, and that could put at the forefront some of the concerns we're talking about?
I don't think that it's realistic, and I would go as far as saying I don't think it's even welcome that we to see a lot of deregulation. I think that's most likely, as I said, it's very important to make sure large banks are are rather a solution in a crisis than a problem. And I think that's what I do expect is that deregulation may come into allowing second-tier and third-tier banks to merge and hopefully also to manage better their liquidity requirements. Because if you really think about what happened in the past, was a little bit of lack of regulation at second-tier and third-tier banks that created eventually quite, by the way, quite basic problems. So it was not really a sophisticated one. So I don't believe deregulation will happen. But of course, what I do hope and I do believe won't happen is more regulation that will create an issue, right? So in that sense, I do think that's a more pragmatic approach also in other jurisdictions around how to evolve or fine-tune the existing regulation would be probably a welcome factor in order to help preventing a crisis.
Suzan?
I'll build on Sergio's points, but again, take them from the standpoint of commerce, right? Because commerce is at the core of how strong financial ecosystems sustain themselves, right? 20 to 30% of financial ecosystems are driven by commerce, small businesses, consumers, et cetera. And you go back at the top of the sort of questions you asked, which is what drives strong ecosystems, I completely agree. Regulation done well is not just an instigator of innovation, and I'm big on innovation, because to sustain innovation in a durable way, you need good regulation. Too much, bad. Too little, bad. You need good regulation, and you need it in the right places. But you also need a way to ensure that that regulation is consistent with how people write policy, write rules, because back to the common person, the small business, the consumer, what they want is consistency. I am selling in markets I don't understand. I want a consistent view on tax. I want a consistent view on the regulatory framework. As a buyer, I want to make sure that the person I'm buying from is someone I understand. Those are the simplicity of things they want. That's what builds trust and sustainability. That's what builds inclusion. That's what builds access. Those things really matter to sustain commerce, and I really care about commerce sustainability in the context of finance.
No, just adding that, from my standpoint of view, if you look at this risk posed, potentially risk or existing risks of the shadow banking system have been created as a function of not allowing traditional banks to do the same job, right? So basically, by making prohibitive requirements and creating a totally unlevel playing field around basic things that we should be doing. Therefore, that's where regulation needs to be balanced, as you mentioned. So because that's where, some of those risks are better managed in the banking system, where we have high degree of requirements in being transparent and how we have to report them. So basically, let's try to see what can be done in order to reduce the shadow banking risk by allowing banks to go back and do what we are supposed to do.
Chow-Kiat?
Yeah, I raise something different. There are concerns about diverging monetary policies, how that could result in some sort of financial stress or even crisis. Our view is that actually, diverging monetary policies per se is not a problem, right? Because each country, each economic system has to deal with whatever issues that they are faced with. The question is about mismatches, right? Whether financial institutions or participants have on their book mismatches in terms of asset liability, in terms of interest rate, in terms of currency. I think the key there is really, some sort of regulations actually for those institutions which are leveraged, but also policymakers, right, paying attention to the speed of change. Right. I think one has to be careful about that speed of change, because if it is too fast, you just get caught without the ability to adjust position. Of course, we want to make sure that the markets are open to allow people to make changes to their position. I think those fundamental sort of infrastructure certainly needs to be the key answer to this.
But where do you think, Chow-Kiat, could you see these dislocations? I mean, dislocations in markets that are violent enough, actually, to lead to a proper crisis.
Yeah, I will double click on what Sergio said about, I guess, interest rate. Right, it could come from fiscal or debt issue, but also inflation. I think that's something that because it hits every asset and every liability. Right, is not only a particular segment. And that, especially given the good performance, actually, of most financial assets in the last 15 years, that adjustment could be very, very severe. We saw a little bit of that 2.5 years ago. Mm-hmm. We don't know what will come next.
Professor Rajan?
Just on Sergio's point that the banks have this bargain with regulators, right? Banks have access to the discount window, have access to liquidity, in return for which they're really regulated much more than the rest of the system. The problem, however, is as the risks have gone on to the rest of the system, the connection between the banks and the rest of the system is not as solid as it was. And so in a situation of crisis, the liquidity doesn't flow to the rest of the system as well as it might. That's the big gap that is building nowadays. The risks are there, but the liquidity is here. And the central bank doesn't have a good way of feeding it through, so it has to help everybody directly. Those gaps are very important, and those are the worrisome part of the system.
But that's what you've been working on, right? Trying to make sure that there's a match with that.
Yeah, no, actually, we want to make sure that these liquidity, sort of these spikes in liquidity demand that we've seen in all of the episodes that I mentioned, that the likelihood of these spikes is becoming much smaller, because each time central banks had to step in, they had the capabilities to stem the turmoil. But of course, you don't want to have that part of the system also being critically dependent on the central bank having to step in each time with extraordinary support. Now, it is true that liquidity distribution, optimal liquidity distribution among the financial system is an issue. It is an issue. Central banks are struggling all with sort of redefining their operational framework, but it seems as none of the frameworks is capable to come up with a satisfactory answer of having this optimal distribution of liquidity across the system. And I entirely agree that the banks, which are the primary interlocutors with the central bank discount windows and what have you, that the banks have to play their role there in allocating also the liquidity to the non-bank system, and I agree there is still outstanding work to be done there. Absolutely.
Suzan, so if I speak to 10 different banks, they have 10 different views of what kind of technological advancement, blockchain, Bitcoin, crypto, AI brings to them, and how they're reshaping the financial sector. What does it mean for payments? I mean, you have a front row view on what it means for people on the ground.
I mean, first of all, again, so many of those innovations have come because of fracture, friction, differences in policy. And in some ways, I kind of agree with the notion that local economies should have their own stronghold on policy, but hopefully complement it with the idea that so much trade is cross-border, right? Because many of these businesses are trading cross-border. So when you look at all of the innovations you described, the things that they're enabling in payments are, first, the ability to create memory. Memory is one of those assets that is so hard, especially as you do business down segments, across markets, across corridors. Who was that buyer? Who is this individual? How do I know about how can I verify, trust, authenticate? And a lot of that memory is being built by tools like Gen AI, where the memory can be captured in the experience to allow things like instant lending at the point of purchase, deferred payment at the point of purchase, instantaneously. That's huge. The second thing that they've helped is personalization. I mean, you think about where the world is going. In today's world, we still store so much data in devices, in the way we provision or encrypt information. But in the very near future, as we think about the way commerce has become ubiquitous, the reality is the individual is that point of storage, my patterns, my habits, my identity. You can imagine a world where my vision actually starts the process for a purchase, my voice authenticates that purchase, and my place, no matter where I am in the world physically, adds a second layer of authentication. Those are the things that are enabling commerce to happen at a much faster pace. One last example is what's happened with all of these digital wallets. I mean, it's amazing that, probably 70% of adults now transact globally. The average age of the person doing a cross-border transaction is circa 25 years old. Commerce is getting younger as populations shift. 1 in 4 people will live in Africa and India by 2030. So if you're following, quote, the money, that's where the money's moving. And it really matters that these innovations, the policy, the structure, the inclusion, the access, follow as well.
But Professor Rajan, I mean, the money is also moving into crypto. It's unclear what kind of blueprint the Trump administration wants for crypto or where it ends up in financial markets. But actually, where do you see, is it a strength or does it expose financial markets, all of this AI technology, especially Bitcoin and crypto?
I think there are aspects of the technology which could be very useful, for example, in payments. Certainly, stable coins are worth exploring. We need to figure out how they will play a role in, certainly in crypto payments, but also digital, all kinds of digital payments. I think the jury is still out on what the true valuation of crypto assets is. Of course, they're on a tear. I think, the issue of should they be held by pension funds, insurance companies, and so on, I'd love to see it go through a cycle before I think we should be really confident that they will maintain the value through. I think the broader issue of payments as a form of inclusion that Suzan was talking about, I think is huge, especially for the emerging markets. The question, again, from a financial stability point is, we've got many more inroads now into lending based on the information, for example, that is generated through transactions. The question is, should the lending be the leading edge of any kind of financial transactions people do, or should they first learn financial management, more how to save, how to manage their household habits, and then move to lending as a second? That's an issue that many central banks continue to grapple with. Yes, we want financial inclusion, but let's not lead with lending, which creates a cycle of indebtedness.
Governor, do you worry, Governor, about cryptocurrencies being more widely adopted? Could they be the source of the next risk or even crisis?
Well, look, I think as long as we take crypto for what it is, a highly speculative asset class, then, our citizens are free to choose their risk profile, right? So where I think it becomes worrisome and where crypto would have the potential to become a financial stability risk is if these investments were somehow combined with leverage. If people sort of borrow a lot to invest in crypto, and then because of the swings in the inevitable swings, I would say, in market prices of crypto, all of a sudden can't redeem their obligations anymore. So as long as it is clear that it is a highly speculative asset class and nothing else, and we make sure that we are sufficiently sort of aware of the interactions with the traditional financial system, because that's usually where the leverage comes in. Let's not forget that banks are the most leveraged institutions in the financial system. Is always something to keep in mind. So as long as we keep that in check, there are many traditional asset classes. Now, there is a small, let's say, exemptions I want to make, and that is, of course, stable coins. Yep. That's a different class, a class with a much higher level of pretension. Yep. Only the term stable coins has a certain level of pretension. And that, I think, requires tighter regulation and more oversight, because there you have also the issue of the reference value, of the implicit promise of redemption that is there, etc.
But Governor, as chair of the Financial Stability Board, how do you engage with the Trump administration, who frankly has put crypto as one of the first executive orders that, you know, at the center of their administration, to try and understand how Europe and the US can either diverge or cooperate?
Well, first of all, there are no counterparties yet in US Treasury, because the whole nomination process of first the Secretary of the Treasury and then the under-secretaries, the assistants, etc., etc. So we have to first await until that process has taken its time, and then we will have to see. I mean, the only thing we can go at the moment is some of the statements that have been made during the campaign, but then again, that is not a basis for me to make policy on. What we have been doing in the past within the Financial Stability Board, we found I would say, delicate balance between the different views that were there in the membership on crypto. Some of them in our membership wanted to have an outright ban. They didn't want to know anything about value added of cryptos. Others, more market friendly, saw the innovative potential and more took the view that you only regulate where you have the risk, but first you should allow the many flowers to flourish, etc. Now, what we found, I think, is an equilibrium where we designed a global regulatory regime of crypto, which was not a ban, which was focusing on the risks, but which can only be successful in case of international cooperation. Because these products are entirely fungible across borders. You can nowadays take a server under your arm, put it in any country and start issuing these crypto assets. So it can only work if we continue to have global cooperation, and this will be one of the first messages that I will ship to my counterpart once there is a counterpart.
Sergio?
No, look, you know, I have to admit that I'm still struggling to understand exactly the value and the merits of cryptocurrencies. I'm not talking about stable coins, but I'm talking about more traditional one. Now, it would be, on the other end, looking at the phenomenon that goes on for so long now, it would be a little bit naive and to just think that it's just speculation. I think it's speculation. We know it's also used by, call it probably not so good activities or and criminalities, but we have to bring it back to the financial stability topic. Many people invest in cryptocurrencies because they don't trust any longer the fiat system and the Bretton Woods system. And particularly here I'm talking about emerging markets and certain places where inflation or political instability is a threat to savings. So we have to really understand if crypto in some cases, and again, I'm not a big fan of cryptos, but is this the new gold? Is that a different way for people to secure a different kind of assets they believe is not in control of the establishment? So I'm not saying that this is exactly what's happening, but there is an element, and I'm hearing more and more people thinking that way. So that's a real risk to financial stability, is that we see the creation of parallel systems.
Suzan?
I want to build on both the governor's point and Sergio's points. The tension between fiat and non-fiat is not a new tension. And I agree some cryptocurrencies are more speculative than others. Completely agree that stablecoin done well, pervasively, regulated similarly, is actually a good mobilizer for commerce. So given that we've launched our own stablecoin, this is an important point. We really want to see cooperation across borders, public-private alignment on policy. But I'll give you a use case for why, Sergio's points need to be emphasized. One of our larger mid-sized companies in Japan sells cars to across Africa, low-cost cars across Africa, multiple jurisdictions, very complicated. Designing the car is quite simple. Getting a buyer, whether it's an agency, manufacturer, or consumer, to get enough foreign exchange to pay for the goods, impossibly difficult. So that's a use case for why, US dollar-backed currency or any government-backed currency may have more stability between the purchase and the ultimate delivery of the good. Very complicated, and it's mid-sized companies that are looking for growth.
Yeah, Chow-Kiat, how do you see these technological changes actually affecting financial systems?
Well, there are two, I guess, features associated with a lot of these financial technology. One is speed. Right? Of course, it creates a lot of efficiencies and low costs and things like that. The speed of that sometimes could be beyond what traditional safeguards and framework can handle. The other is herding, right? It just generates that whole crowding effect. I think those have implications for financial system design. But I'm sure the policymakers and authorities are looking at this closely, but I would pay particular attention to this.
Yeah.
Maybe I could raise another one, which is, I mentioned concentration, right? I think a lot of these positive momentum are happening in the US, right? You see in a lot of portfolios, there's increasing concentration of US exposures. Just look at traditional listed equities, right? US stock markets is 70% of the world stock market. And you add to these other things, right? Shadow banking, private market assets, cryptos, you probably get an aggregate average number of 90%. So question is that an issue, right? Earlier, when I mentioned about divergent monetary policy, this is also could create that gap, that mismatch. I think at the global level, this certainly is, an important issue to pay attention to. It also speaks to what I think Professor Raghu said about whether you could have some sort of global coordination, right? When something like that, if there's a crack there, what can we expect?
But do you think concentration in the U.S. is a concern? Do you think the next crisis will stem from the U.S.?
Yeah, I would say any concentration is a concern, right? Whichever block. Of course, it varies depending on different institution and what your portfolio is about, what your liability is about. But from a system point of view, a big concentration, if something happens, there certainly has a much bigger impact on the system. So that's the lens that we're looking at.
Professor Rajan?
No, I wanted to, first, I mean, we're seeing the Matthew principle sort of big and large, right? Yeah. To those who have, more will be given. And that's happening in the financial system. But to the point about, yes, in some of those African countries, it's easier to trade in a crypto or a stable coin than in the local currency. But of course, that has a downside effect for that country because they lose seigniorage revenue. There's more flight from that particular currency. And of course, if there's any hint of trouble, the speed at which you get a downward shift in markets in those countries increases. So with all this new technology, the ability to evade any kind of border controls, etc., and that hurts most the emerging markets and developing countries who don't have strong, stable financial structures, makes them even more vulnerable.
Francine, I was smiling because I was thinking that it's difficult to think about a crisis that hasn't started in the U.S.
But we're also optimistic about the U.S. now.
I mean, it's just...
How can we mitigate that, Sergio?
No, I mean, this is the cost of having such a great country and economy with innovation and so on and so forth. So that is a risk-reward kind of issue. The truth of the matter is that the Americans and the U.S. is able to learn out of a crisis and to change quickly to restart the engine. Yeah. That's what we need to, learn outside the U.S., particularly in Europe. Yeah. How to use crisis to reset and change.
Resolution mechanisms in the U.S. are very efficient. So
simpler.
In popular words, cleaning up the mess after the mess has been created is more efficient in the U.S. than anywhere else.
So what should we learn from the U.S.?
Yeah, that is what we can learn from the U.S., I guess. Also, on the European side, where resolution is much more tedious, often a much more political process, etc., that I think is something that we can...
Ask for forgiveness and move on.
Yeah.
We have a different system. There's more negotiations in Europe.
Yeah.
Than at the Federal Reserve. Governor Knot, when you look at the U.S. and, of course, the last financial crisis, I mean, is there always this tension between safety and growth? And is Europe on the back foot on that?
Well, I think let's say the recapitalization of the banking system after the global banking crisis shows that this trade-off is often exaggerated a lot. I think at the end of the day, there is a wealth of research showing that better capitalized banks provide more stable lending to the real economy, not less stable lending to the real economy. So whenever there has been a sort of deregulatory sweep and sort of let's slow down a bit on capital requirements, etc., at some point, that always came to haunt us. Let's also not forget that the mini banking crisis in 2023 in the US, it struck the banks that were kept out of the global regulatory regime because the regulators felt that they did not have to suffer such tight regulation. Well, that was the price that one then pays. So I'm hesitant to go along in this trade-off. It may be there in the short run, but it typically comes to haunt you in the slightly longer run.
Professor Rajan, how should we look at these potentially massive trade tensions between the US and China? What does that do to financial stability?
Well, I think the system has been decoupling, though we keep using the word de-risking for quite some time. I think it's hard to decouple totally when you have such strong trade links on the it's hard to decouple on the financial side. I'm hopeful that, there is obviously a negotiation process underway, and so you sort of settle at something which is not totally disruptive. But I think these trade issues could become problematic, not directly into the financial system, but to the extent they disrupt the real system and then go back into the financial system. We are, to Sergio's point, I think asset prices, et cetera, all at very high levels, which suggests if there is disappointment, there's a lot of potential volatility down, and that's when we see where are these asset prices combined with leverage. So, yeah, in a system which is so priced for perfection, any kind of shock would be problematic, and especially something within the two biggest economies in the world.
And Professor, do you think if we had the financial crisis today that we saw in 2008, would governments around the world come together, policymakers come together as they did then to fix it?
It's hard to see that, given the kind of fracture that has happened, given the kind of antagonism between different parts of the system, and given the fact that it's not clear who the leader would be at this point. I mean, at that point, you have people like Gordon Brown stepping up and bringing the world together. It's not clear whether there's acceptance and there is leadership. Maybe the moment brings the leader, but I do worry. It's also not clear that governments have the kind of fiscal space they had then, and that too is a concern.
So we have 4 minutes left. I'm going to ask each of you, given the great conversation that we've had, Governor, what would you focus on in the next 12 months to either mitigate risks for the next crisis or strengthen cooperation if a crisis came to fruition? What would you work on?
No, our role is firstly to mitigate the risks and to finish the unfinished business that I predominantly see in the non-bank financial intermediation space. And of course, as the FSB, we will continue to play our role as a forum for international coordination. I will make sure that I get to know my US counterparties as soon as they are there, and that they get to know their other counterparties as soon as they were there, that if a crisis hits, at least we all have each other's phone numbers. We know the faces of the people that will be on the other side of the line when we need them, etc.
Suzan?
The face of who's transacting globally continues to change, and identity, therefore, is one of the most important aspects of how we think about how to underwrite commerce more responsibly. And so of the two things that I would push on, one is to improve the quality and transparency of data, leveraged by good privacy policy as well as just good cooperation across businesses, industries, public sector. And then the second one, actually just building on the professor's point, is, 10 years ago, the world was less global. There was less at stake for big industry, small business. Today, small business is as global as big business. there's a lot more at stake. And so the second piece would be just good private-public cooperation, because businesses and therefore consumers depend on us finding level, cool playing fields.
Sergio, what would you focus on?
Well, our focus, I mean, I guess any business has to stay focused on running a profitable and sustainable business, and because this is the real first line of defense, right? So if you are struggling in this environment, you should be very worried, because everything is aligned for perfection. It's a pretty still benign environment. So number two is constantly stress test your balance sheet, your assumptions, knowing that none of these scenarios will probably be the one that materialize, and don't pretend to know what it is, but it's actually work around the magnitude of what can happen, and also understanding, more broadly, what are the second order effects? Because of course we spend a lot of time in thinking about first order effect on us, but the true killer is the second order effect. And so something that we can't control, and so we need to live with it.
Chow-Kiat?
Yeah, I'll invert, right, to kind of think about what can go wrong and make sure we don't go there, right? So I've already talked about the fragilities and negative shocks and stuff like that. But I think for the system, there is a need to, I would say, sort of re-emphasize or raise the understanding of the importance of making sure the financial system doesn't go the way of the trade system, right? The trade system has, I think, fractured, and I think a lot of political leaders have found it difficult to talk about trade. It's like a dirty word now. So I think we must not let the financial system fall into that trap as well. So I think there is a need to do advocacy, and of course, make sure that the politicians understand the importance of keeping the infrastructure in good place.
Professor?
Well, no longer a central banker, so I'll talk my book. We will help you with the research so that you can do the advocacy. And
So it's really about getting to work. Like, we don't know where the next crisis is, but if people are serious, keep their head down and work hard, we'll get through the next one. What kind of time frame? Should we have a final round of how quickly could we see a new crisis?
This is too risky a question for me.
Professor Rajan?
not near, but not impossible over the next few years. I think it has to build. It has to build, and it has to build, I think, to your point, in an environment of complacency. That's when the seeds are set. So I would say there's nothing flaming except perhaps interest rates right now. But I think we have to be very careful over the next few years, especially as we deregulate and go forward.
Well, thank you all for a wonderful panel. There's a lot to think about and a lot to try and keep stable. Thank you.
You're welcome.
Thank you, everyone.